A modern F1 race car can easily go over 200 miles per hour, but when things go wrong, that car is out of the race entirely. That is not acceptable when it comes to our money. This is the video you want. We are going to talk about 3 options everyone can use to live off dividends faster, because on paper, these investments have higher than typical dividend yields. But this is also the video that you need, because with these supercharged dividends comes higher risk, and I'll go over those as we move forward. But I'm also going to give you the math I did so we can figure out together what the fastest way to live off dividends actually is using some real examples. Now remember, I'm not a financial advisor and this isn't financial advice. It's impossible for me to tell you what's best for you and your portfolio. That's a conversation for you and a professional. All right, let's establish a baseline for our dividends. Let's say our goal is to make $36,000 a year from our investments and never touch the principal. The ETF VOO tracks the S&P 500 index and it has a dividend yield of around 1.5%. That means if we wanted to make $36,000 a year or $3,000 a month in passive income from VOO, we'd need a total of $2.4 million invested. Getting up to $2.4 million, even with compound interest, is going to take some time, probably decades, depending on how quickly the position grows and how much you put into it. But since we're interested in speed, enter option number 1, high dividend yield ETFs. If you've spent any time in the market, you've probably heard about exchange traded funds, which is where our money is pooled together and invested by professionals. And you probably already know that out of over the 2,700 ETFs available, they are not all created equal. We already talked about VOO, so let's look at the very popular QQQ, which tracks the NASDAQ 100. In other words, QQQ is an ETF that focuses heavily on large tech companies. Its dividend yield is 0.53%, which is incredibly low. And yes, historically the growth has been insane, but this also comes with a lot of volatility. If we're trying to live off dividends at a faster than average rate, we want something that has a higher dividend yield, and we want more stability for our peace of mind as well. Options like SCHD with a dividend yield of 3.5% or SPYD at 4.91% certainly seem like good options. Of course, you run the risk of underperforming the market with these options, in some cases sacrificing overall returns for a higher dividend yield. Option number 2 is REITs, or real estate investment trusts. This concept is really simple. Investors buy a share of REITs and the company buys and manages physical property. Investors get paid dividends from the profits, which in the case of REITs, they are legally obligated to pay out 90% of those profits back to investors. One of the best REITs that I've come across is O, or Realty Income Corporation. It has a dividend yield of 5%, and some other popular REITs are Stag with a dividend yield of 4% and Maine with a dividend yield of 6.5%. But remember, if you decide to invest in a single stock, you're risking your money, because if that company cuts its dividend or goes bankrupt, your income and principal go with it. And generally speaking, REITs are not tax efficient. Option number 3 is covered call ETFs. These work like other ETFs you've heard of and ones that we discussed in this video, but these use a covered call strategy to generate higher dividends for investors. Basically, the fund managers will write options contracts and collect a premium. That premium gets paid out to holders of the ETF. Some of my favorite covered call ETFs are JEPI with a dividend yield of 6.27% and JEPQ with a dividend yield of 8.95% if you're feeling more risky. And speaking of risk, if an options contract is executed, the fund could be forced to sell shares at a loss. Covered call ETFs are also generally new investments, so we don't have a long history to see how these assets have performed over time. They're also not very tax efficient and will not perform as well as other investments during bull markets due to the nature of covered call ETFs. But even with all these negatives, some covered call ETFs are offering higher than average yields and may work for some investors given the right market conditions. Some of these other covered call ETFs include QYLD with a dividend of 11.95%, SVOL with a yield of 15.78%, and TSLY with a yield of 76.38%. Keep in mind that the overall performance of these ETFs have been questionable at best, so these very likely might be dividend traps over the long term. Given the excessive risk of QYLD, SVOL, and TSLY, we won't be discussing them in our next part of the video, which is the math. The easiest way I found to figure out how long it would take to get to $36,000 in yearly dividends from the investments we mentioned earlier is to first figure out how much we would need in the position overall today. Then set up a hypothetical dollar cost average calculation using a calculator from Dividend Athlete and see how long it'd take to get to where we need to be. For simplicity's sake, we're not going to factor in inflation or taxes, and we'll be using an average annual growth rate for the past 10 years when possible. And if it's not possible, we'll be using the average annual growth rate since inception. We're also assuming that the dividends will be reinvested when they're paid out quarterly, and we will be assuming a dividend growth rate that matches the share price appreciation. We'll be using the yearly dividend yield for each investment as of making this video in early August of 2023. And finally, we'll start with $10,000 initially in each position and contribute $6,000 a year, which works out to about $500 a month. First up is VOO, which will be our baseline for speed. VOO has a dividend yield of 1.5%. So if we wanted to make $36,000 a year in dividends, we'd need a $2.4 million position. The average yearly return for the past 10 years is 12.45%. And plugging all of this into the calculator gets us past 2.4 million in 31 years. Next up is QQQ with a dividend yield of 0.53%. Getting $36,000 a year from it would require us to have $6,792,453.83. The average yearly return for the past 10 years is 18.53%. Plugging all this into the calculator gets us past $6,792,000 in 31 years. As far as SCHD is concerned, it has a dividend yield of 3.53%. To get $36,000 a year from it, we would need $1,019,830.03. The average yearly return for the past 10 years is 11.53%. Plugging all this in the calculator gets us past that $1,019,000 in 23 years. Let's take a look at SPYD. It has a dividend yield of 4.83%, and to get $36,000 a year from it, we'd need $745,341.62. The average yearly return since inception is 7.6%. Plugging all this into the calculator gets us past $745,000 in 24 years. What about our REITs? O has a dividend yield of 5.04%. To get $36,000 a year from it, we'd need $714,285.71. The average yearly return for the past 10 years is 7.5%. Plugging all this into the calculator gets us past $714,000 in 23 years. STAG has a dividend yield of 4.08%. To get $36,000 a year from it, we'd need $882,352.94. The average yearly return for the past 10 years is 9.46%. Plugging all this into the calculator gets us past $882,000 in 24 years. Maine has a dividend yield of 6.53%, and to get $36,000 a year from it, we'd need $551,301.68. The average yearly return for the past 10 years is 8.56%. Plugging this into the calculator, we get past $551,000 in 19 years. And now for our covered call ETFs. JEPI has a dividend yield of 6.27%. To get $36,000 a year from it, we need $574,162.68. The average yearly return since inception is 13.19%. Plugging all this into the calculator gets us past $574,000 in 17 years. JEPQ has a dividend yield of 8.95%. To get $36,000 a year from it, we'd need $402,234.64. The average yearly return since inception is 10.23%. Plugging all this into the calculator gets us past $402,000 in 15 years. So based on the data, our winner is JEPQ, getting us to $36,000 in yearly dividends in 15 years, which is 16 years less than VOO. And according to the math, you'll get there even faster if you invest more money up front and contribute more money over time. But before we throw all our cash into this one investment, we need to remember that returns aren't guaranteed. Investments may not perform as well as they have in the past, and we should always be aware that just because we plan for things to happen doesn't mean they will. In addition, these higher risk assets generally come with higher volatility as well. I mean, just look at the 1-year price chart for JEPQ. It's not exactly stable. What you should take away from the data is that high dividends aren't the only thing to consider when growth and stability are clearly very important. A steady growing asset can help fight off inflation, help avoid dividend traps, and something like VOO is considered safer than some other options on this list, which is important to us if we're planning on living off of these assets in the future. And of course, we can't forget to consider where we are investing as well. 401ks, Roth IRAs, and individual investment accounts are treated differently when it comes to taxes. So this is a great time to speak with your financial advisor about setting up a plan to get to your long-term goals based on your options available. If you're interested in my personal top 5 monthly paying covered call ETFs, check out this video here. If you found value in the video, click that like button, subscribe for more content, and as always, have a good one. Take care.